Hey everyone, welcome to my channel. I'm Ray Kang. I'm a commercial real estate broker here in Texas that works with retail center owners and investors, keeping them informed on what's going on in economic and retail news and helping them make better returns on their deals. This is our weekend wrap for December 27th, 2025. We're going to cover first the economic news behind the consumer from the past week. Second, taking a look at what retailers are doing right now, and we'll also cover a topic at the end with what I'm seeing with strip center owners, especially in our low vacancy market like today. Yeah. Let's start with the economic news I've been paying attention to this past week. According to the Commerce Department, disposable income is rising, but it's really just keeping pace with inflation. Their preferred inflation gauge, the PCE index, is still running in the high 2% range. And that tells us households still haven't fully regained the purchasing power they lost over the last few years. What stands out is that despite the pressure, people are still spending, especially on essentials like tuition, utilities, food, and prescription drugs. And this isn't discretionary splurging. This is the cost of living showing up in the data, the cost of just living and breathing. And the trade off is savings. So I was reading through the savings data, and the personal savings rate has fallen well below pre pandemic levels. And that tells us the consumer is still participating, but with less margin for error. When that cushion gets thinner, value and necessity matter. The second piece of economic news comes from consumer sentiment. And according to the Conference Board, consumer confidence fell again down to 89.1. Fewer people say jobs are plentiful. More say jobs are harder to get, and a growing share of households expect their income to decline. That doesn't always show up in spending immediately, but it often changes behavior over time. One last data point that matters for retail, which is housing. And according to the National Association of Realtors, home prices remain elevated, but transactions are still sluggish. Homeowners are locked into low mortgage rates and don't want to move. And that lack of mobility matters because retail follows rooftops, but big move driven spending stays muted when people aren't changing homes. So when you put all of that together, you get a consumer that's still spending, but more careful, more selective, and more value based. And you could see that clearly in what retailers are doing. So let's talk about what's happening on the ground. I spent this week reading through the latest QSR drive-through research, and I think the message was pretty clear. Growth right now is coming from efficiency, not aggressive expansion. Speed and order accuracy continue to drive customer satisfaction, but what really stood out to me is that brands aren't just depending or adding new technology, they're redesigning operations to remove friction as much as possible. And that matters for real estate. For drive-throughs especially, the stacking, queuing depth, ingress and egress. Now, these aren't just nice to haves anymore. They're directly tied to the retailer's revenue. So a site that is crowded or bottlenecks cars during peak hours isn't just inconvenient, it's leaving money on the table. And that explains something landlords and owners are seeing right now. You'll hear a tenant say that they're in growth mode, but they'll pass on a lot of locations. They're not saying no to that submarket or market, but they're saying no to that site because they know what works operationally for them. Now, I also spent some time going through the National Retail Federation's list of fastest growing retailers. What you see there isn't reckless expansion. You see brands with strong value propositions, high frequency visits, and formats that work across different economic environments. Expansion, as you know, is happening, but I will say it's more disciplined. Smaller boxes, very specific, better sites, much more data involved, and tighter underwriting for everything. Now, as we know, demand for retail is strong for that space, but it's a much more studied and specific process, and the bar is just that much higher. Now, on the other end of the spectrum, I was reading a retail dive piece on Saks Global, and it's a good reminder for owners with exposure to large format or legacy retail. Now, the pressure there isn't just about demand, it's about balance sheets, overlapping footprints, high lease obligations, and tighter capital markets forcing retailers to make faster decisions around store closures and restructuring, sometimes regardless of how an individual store is performing. So the takeaway for landlords isn't that a brand like Saks Global or their brands are disappearing. It's that credit quality and lease structure matter more in today's environment. Retail is always evolving and it's sorting itself out. Operators with strong unit economics, operational efficiency, and healthy balance sheets are still moving forward, and those without those advantages are being forced into tougher decisions, and real estate is often where those decisions show up first. And now this brings me to my owner takeaway I wanted to focus on this week. And there's something find in common with our high occupancy market that we're in, with owners just saying, my property is fine because it's fully leased. We're 100%. All things are good. Now, I get it. Full occupancy feels like stability. It feels like all of the hard work is done. But the issue with that belief, full occupancy is not the same thing as full performance. And it's definitely not the same thing as the best return on your investment. In today's environment, how your income is generated matters just as much as whether it's coming in. For example, we'll look at a strip center that's 100% leased, and we constantly do BOVs and financial analysis for our customers and clients. And on the surface, things look great, but when we dig into the rent roll, OpEx, we find several tenants are below current market rents. Lease bumps have been minimal or even flat, and expenses have grown faster than income, and more specifically, in particular, over the past 5 years. In many cases, we've seen income, grow from 16, 17% over the past 5 years, but due to property taxes, inflation, and insurance in particular, operational expenses have grown 30 to 40% across the board. It's growing faster than the income. So while the center is full, the cash flow is quietly falling behind the market. And you really need to dig into that. And of course, over time, that shows up in a couple places where your return on equity stagnates and your exit value suffers because buyers don't pay for occupancy, they pay for durable, growing NOI. And this ties back to the retailer behavior we just talked about. Retailers are underwriting sites more carefully. They care about operational efficiency and long-term unit economics. And if your rent roll and leases aren't aligned with today's market, you're carrying more risk than you think, even at 100% occupancy. So the better question for owners isn't, is my property full, so to speak? It's, is my income positioned to stay stable and competitive over the next 5 to 10 years? Because stability doesn't just come from a fully occupied center. It comes from alignment between tenants, rents, leases, tenant credit quality, and of course, today's retail reality. So that's our weekend wrap. The economic news tells us the consumer is still spending, but with less cushion. Retailers are responding by prioritizing efficiency, value, site quality. And for owners, the opportunity is to focus on durable cash flow, not just full buildings. If you want help thinking through your tenant mix or leases or your long term strategy, you're more than welcome to reach out. You can find my contact information in the description. I'd be more than happy to bring you something of value. And also, before we go, I wanted to give a shout out to a content partner. Some of the economic data and context I reference each week comes from Share Scoops. I work with them because they help advisors and financial advisors and advisors like myself in real estate in cutting through a lot of that noise and help explain what's actually happening in the economy in really plain English without all of the difficult terms and all the hype. So I've partnered with them to share a discounted sign up link for their services, personalized for my audience. If you're an advisor and want to help your clients understand the markets and assist in making better business decisions, check the link in the description. It's completely worth it. So until next time, take care, and I'll see you next week.